Hey traders, welcome to Charts and Coffee. Hope everyone is having a good morning and ready for what will be a pretty impactful week in terms of we've got the end of quarter and the triple witching OPEX. The Federal Reserve is on Wednesday and there's a lot of uncertainty overarching that meeting coming up. We'll talk about that as well. I dove into a lot of detail on that, by the way, in yesterday's top tier outlook, where we discussed the expectations on the target rate probabilities. In other words, what are the Fed fund futures saying about what the Federal Reserve is most likely to do on Wednesday, and how that 50 basis point cut is really starting to gain some momentum in terms of the expectation, which could be problematic if the Federal Reserve has no intention of cutting a half a point. So we've got a lot going on here this morning. On Sunday, I discussed also the way in which I look at the roll, the contract roll. You'll notice that there's a green line right there on my chart. I put it there to remind myself as well. But there's a green line there on my chart, which reminds us that the charting platforms use what's known as the pit date or roll date. I used to call it the pit date. It's known more commonly as the roll date, where before the contract, in this case, September, and that would be the ESU24. Now that one's trading at 56.25, right? So where September's ending is in this range. In other words, the sentiment that's ending September, this particular contract, this is where this one's ending, as opposed to the optimism, frankly, the optimism around what's happening around December. It's a higher price, right? You can see there it's about a 60-point higher expectation for the S&P is going to go. But ultimately, they're both in a range, you'll notice. But I look at the continuous contract, all right? I look at the continuous contract because as I was mentioning last night, as we look over the year, no one's saying, looking back, oh, this was the March contract, and then, oh, here's the June contract, and here's the September contract, and oh, now we're in December. No one's differentiating the price when you look back over the year based on the 4 quarterly contracts. We just say, hey, this is where the S&P futures are, and I'll do that knowing that partly that hole on the chart is the roll from September to December. And I address also, look, gaps don't have to close, not immediately. They don't have to do anything. Do they typically tend to? Yes. Is there a timing around it? No. In other words, is today going to be the day the gap closes? Oh, gosh, no, right? There's no timing around that. We just know there's a tendency for them to be closed. And if it were to close, that's on a calamitous move. That would just basically take us back to about 56.26 3/4. Not a big deal. In fact, that might be actually a buying opportunity. The other thing that I mentioned is as we go into Wednesday, if the Federal Reserve gives the market at large a 25 basis point or quarter point cut, when the expectations continue to climb for maybe a 50-point cut, that could be a little bit of a letdown. Right? That could be a little bit of a letdown. But here's the thing, gang, and I'm really kind of getting maybe a little salty about all of this. And that is the constant fear-mongering around what's happening right now, right? This is a chart of a market crash timeline that takes us back to 1870. All right. So I'm going to talk to you about what bearish analysis and where, as a trader, you can or cannot choose to listen to it. All right. So first of all, let's just accept, because the data is there. This is not something that in any way is up for debate. It's just a fact. The markets move higher. Given enough time, stepping out, if you were just to leave your money somewhere, you'll leave it to the long side. The only thing that perma bears, does everyone know what a perma bear is? It's someone who's always bearish, hence the perma, right? The only thing that perma bears are is wrong. That's all. They are at scale over time wrong. And it seems to be a very difficult thing to kind of get across. I like this darker view better. It seems a really difficult thing to get across to folks when the recession, the whatever the newest fear du jour is out there, is running amok. Perma bears are wrong, except for small little pockets where they get invited on television because after picking 19 tops, they were finally right on their blog that nobody reads. I mean, or whatever it is. Yes. So the other kind of bears are folks who want clicks. They want your attention, right? This is a bull trap, it's a bear trap, I don't know, it's a mouse trap, whatever it is, right? This is the inflection point, this is the beginning of the crash, it's recession, whatever it is. Again, so please remember, here's where we can find some sanity in all this really bad and arguably wrong discussion. What are you and I typically doing? This is how I keep my eye on the horizon. Those of you that are boaters know, right? When the things get choppy, what do you tell someone who you see is trying to get kind of getting seasick? Tell them, hey, go where the wind is in your face and go look at the horizon, right? All right. So what do we know about what you and I are likely to be doing? Now, I can't account for everybody. I think it's a really good place to center yourself, especially this week. Typical time horizons for traders are 2 to 10 days, not 2 to 10 months, not 2 to 10 years. So if you're saying, Rog, I'm 2 to 10 minutes, I'm 2 to 10 hours, great. If you have defined your typical life cycle of the trade, your time horizon, you are ahead of 98% of traders who have no clue what it is their commitment to a particular trade is really all about. So kudos, you're fine, right? It's those traders out there who think that a trader with a 2 to 10 day time horizon, in other words, you'll be in the trade for maybe 2 to 10 days to expiration, actually gives a rip about whether or not we're going into a recession. That's not trading information. That's turn the television on, let me scare you so you stay glued so we can sell you all the ads that we are keeping the lights on with. And so that's where I listened to the television a little bit this morning, and it's just frustrating as all get out. And so folks are really scared again, which tells me a lot of traders out there don't have a plan, right? Don't have a mentor for a plan and don't have a plan. That's what I hope to provide for you all when we do the free videos, we do charts and coffee. My plan is to find trades that will follow through for roughly 2 to 10 days to expiration. So case in point, I have a number of positions that'll be expiring this Friday, and I want to get out of them before that September 20 expiration. Most of these trades have been on for 3 weeks or less. So no, I don't care if we're going to crash. I don't care about the recession. I do in some ways care about what Powell's going to do because that could create some volatility. But guess what? I'm a trader, right? What could I do? I could close out my winners, kick my feet up, and me and the Sector Secrets Mastery folks will rebuild a watch list. And if there's a crash, we'll have a wish list ready. That's what a plan is, right? My mentors gave me a plan, and that's what I'm hoping to give you all. You can have a plan. And if you are concerned about a much more precipitous drop, something that would exceed even what we saw at the beginning of August with that carry unwind, have a wish list. Have that weekly time frame list of stocks. And if we quote unquote crash, if we exceed more than say a 10% pullback, that you can go bargain hunting, you can go shopping, right? And that's also a plan. We look for where we can say, hey, there are a number of names that if they pull back this much, absolutely, I would love to get in, right? And so if you have that, is a crash bad, or is a crash simply an opportunity for you to have a longer time horizon, 6 months, years, and say, look, where we are now is not where we're going to be in 6 months or a year, right? So what can I buy at a good price rather than chasing it up to higher highs, right? What can I buy at a good price? And again, that needs a plan. So whenever there's fear out there, you beat it back with a plan. You beat it back with knowing what kind of trader you are. And the amount of anxiety out there right now just tells me a lot of traders don't have a plan. We're rolling through August. We're rolling through September with a number of winners. I mean, right now, I'll tell you, my biggest problem is how am I going to replace all these winners in my book with a new batch, a new round of winners as I have to scale out and close Coke, Gold, RTX, XLP. We just closed out IBM where we bought a contract for $4.20 and scaled that at $15.55, right? If you have a small account, maybe about one or two of these, maybe you spent $400 to $800 on this trade idea. And then as the trade went in your favor, now you're scaling out of those one or two trades at $5.50, $6.50. And that's where account growth is. That's what a plan looks like, right? Where are those names that continue to go higher? And by the way, if you watched the video from last week, you know exactly where it is. And I'm continuing to focus on it's the relative performers. It's the things that are going higher. Okay. All right. So let's go ahead and jump into our questions. And let's see, Danny says, good morning. I'm sorry. There we go. Danny, where'd you go? There you are. Good morning. Friday, the hourly price movement ranges for 5-minute ES with a freaking ATM. Very cool. Have I found anything that is pre-market that will give you an indication of potential accuracy for the day? It's not a matter of accuracy, Danny. Remember, the hourly price movement ranges are measuring or giving you the measurements of what's 68% most likely in terms of ranges. So I never presume, I never start off the morning thinking they're more or less accurate. I'm always going to presume they're reflecting a 68% probability, which isn't really good. If someone told you roughly 7 out of 10 times this is going to be the case, pretty good accuracy, right? So then the next part of it is, are there things that could increase my expectation that we have the potential of exceeding normal, the 68%? Yes, mostly it's the calendar. Mostly it's going to be events on the calendar. So today we have core retail sales, I believe. Wednesday, we're going to have the FOMC. So would I imagine we're going to exceed the normal probability after 2 p.m.? Probably. So I look at the calendar. I look at also if there are significant gaps, meaning once the session opens, are we seeing, but even the gaps aren't even that big a deal. Really, most of it's the calendar. So if you're ever concerned, Danny, that we could exceed, and this applies to daily price movement ranges too. If you're concerned about going outside that 68% probability, I would say look at the calendar and certain events, hot zones as I call them. They will likely be the best, most consistent, most easy to identify thing to let us know that on this day, there's a possibility, not a probability even, that there's a possibility based on the data and the reaction to it, we can exceed that 68% expectation, which again is almost 7 out of 10. So it shouldn't happen all that often, and you'll probably notice it typically doesn't. All right. Next up is Panthers are king. Yeah, quad witching is a bit of it's really triple witching. There's no stock futures, but so quad, triple, but just no, quad isn't really real. But the triple witching, it's a lot of volatility. That's how it affects the markets. It's a lot of volatility. And then the volatility tends to glom onto open interest. So the biggest thing that's affected or affecting the stocks and the ETFs going into expiration, in this case, the triple witching, is its futures and its options. And, so the things that are expiring on Friday is where the open interest is. So you have to have a plan around how you view the I hate using the word max pain, because I think max pain is categorically wrong because it reduces the Friday, the OPEX, to a single level, when in reality, there are multiple levels that we consider when we're looking at the behavior of a Friday. We look at where the open interest is and how do we determine where price has to close to render the largest number of options worthless. That's the answer. And that's the effect of the end of the week. All right, so let's take a look at our indices this morning. Again, all 4 of them are actually well above, except for the NAS. NAS is up 0.83%. S&P's up over 1%. Russell and Dow again are up over 1%. So we're looking at a pretty strong morning. Again, some of that could be the roll, but don't think the roll isn't real, gang. Don't think that just because we jumped from September to December that price isn't real. It's very much real. It's just reflecting the contract that ends in December. And so if you say, look, where we ended in September is at a certain level, but where we think we'll be in December is higher, that's bullish. That's generally bullish. But if there is going to be an event that could start to erode some of this strength we've seen, could create the resistance up here, we're at previous highs or around previous highs. It's going to be where this September 18 probability is. Now, don't worry about that. It's 63 by 37 right now. We need to know where it is Tuesday's close. We need to know where it is before Wednesday at 2 p.m. Then we'll get a read. It could do whatever it wants right now. We need to know, what does this look like on Wednesday before the Federal Reserve makes a decision, because that's going to be what's most expected. And ideally, and again, this part is my opinion. This part is absolutely my opinion. Ideally, the half point cut column, which is this column right here, ideally the half point cut column just sort of shrinks back down, and this quarter point cut column increases, so that the Federal Reserve says, you know what, when we meet on the 18th in 2 days, we'll give them that quarter point cut, and we can keep on with a quarter point cut at each one of these meetings going into June of next year. Right? That would be a pretty easy pace to keep. Now, they might decide to give us a half point cut. They might have to if this expectation is still very, very high. If it goes to 80%, I would expect that fully discounted. And if we get there and they don't give us a half point cut, yes, we will likely see a little bit of a sell-off. But as long as the press conference, let's say we don't get a half point cut and expectations are high for it. As long as the Federal Reserve says, look, we're giving a quarter point now, but we're really on a steady track of lower rates going forward, and expect us to continue to be pretty active with the quarter point cuts at the next few meetings. They won't be that clear about it, obviously, but as long as they keep the door open, that'll be great. So this is a problem for the Federal Reserve. I mean, Jerome's waking up this morning going, oh my gosh, clearly there's one of two scenarios. Either one, they really do intend on giving the market participants that half point cut, or the second scenario is, gosh, we just weren't clear enough about what our intentions are. I know, shocking. But we weren't clear enough about what our intentions are, and they're expecting us to cut half a point, and we don't really want to. That's where the problem comes in, and that's where we could see a pullback into the range. But look, gang, this notion that exhausting at 5,700, and if the Federal Reserve doesn't give us a half point cut, we're going to, I don't know, whatever ludicrous numbers out there, 5,200, 5,100. Gang, how about we start with, if the Fed disappoints, that expectation of a half point cut, maybe we pull back to 5,600. We pull back to the daily price movement range, or whatever that level is come Wednesday. Maybe we make a half, maybe we go halfway through the range. We pull back to just below 5,500. That's still a pretty good pullback. Or if there's really a lot of fear, maybe we just go all the way down to the lows of September and retest 54. That's what I'm looking at. Look at where we're most likely to maybe pull back within the context of the current range, right? And go from there. That's it. That's all I'm looking for. And we may not get any of those scenarios. But again, there's just so much fear right now, which some of it technically is merited, because we are arguably, again, we are in chop. So all of this is chop. And in the context of a chop, yes, we have overbought, we have oversold levels, and we could definitely make a good argument that where we are right now is overbought and that it's due for a little bit of a pullback. Overbought is not to say, well, once we get here, we're going to crash. I mean, these words are used so recklessly and cluelessly with such frequency that it is pretty amazing when you really get a look into what trading psyche is out there. Traders really are their worst enemy. It's not hedge funds. It's not algos. It's traders. Traders are really their own worst enemy. They don't have a process. They don't have a plan. And then they're, obviously going to be swept away with whatever, again, the new fear headline is. So that's the reality of where we are in the S&P. NASDAQ is not quite as strong, because a lot of the sectors heavily weighted within the NAS aren't nearly as strong as what's happening in industrials, financials, and healthcare. So some of the sectors that are strong right now are benefiting the S&P and Dow more so. Remember, staples and gold miners are still your leaders. in terms of your outperforming sectors, and tech is still kind of laggy with the exception of XLY, which is something that we've been trading in the sector secrets mastery. Consumer discretionary looks a whole lot better than the NASDAQ, doesn't it? So these are things that we're watching. We're going to continue to focus on them as we go forward. And as always, gang, remember that as a general rule, rate cuts are never bearish. I shouldn't say never. These are not emergency rate cuts, gang. These are just rate normalizing cuts. And as a general rule, unless we're disappointed by a smaller than expected cut, they're typically not bearish. Okay, be good to each other, gang. I'll talk with you tomorrow.